Today's lesson will cover bookkeeping and accounting. Bookkeeping is the systematic recording of the daily financial transactions of an organization so that the financial position of a business can be readily ascertained or determined at any time. Accounting is the act of recording, classifying, analyzing, summarizing, interpreting, and communicating financial information of an organization to various end users of such information. Differences between bookkeeping and accounting. Bookkeeping concentrates only on the routine recording of transactions, while accounting goes beyond the aspect of recording to classify, analyze, summarize, and interpret financial information. Bookkeeping is limited in scope, that is, area of coverage, while accounting has a wider scope. The time required for training to be a qualified bookkeeper is shorter, about a few months, compared to the training required to become an accountant. Users of accounting information and financial statements. The following interested users of financial information should be noted, as well as the purposes for which they would require or utilize the relevant information. Owners of the business. To determine the profitability of the business. To assess the competence of the managers of the business. Shareholders of a company. To determine the profitability of the business. To assess the ability of the company to pay their expected dividends. Loan creditors, that is, lenders to the business. To assess the ability of the business to repay loans. To assess the ability of the business to repay the interest as and when due. Trade creditors or suppliers, that is, those that supply goods to the business on credit. To assess the creditworthiness of the business. To assess the ability of the business to pay back its debts. Competitors. To fix their own prices relative to the prices of similar products produced by the business. To determine their position in the market, that is, market share in terms of sales, profits, number of employees, etc. Customers. To know if the business is a guaranteed or secured source of supply. To assess the financial position of the business. Employees of the business. To know the profitability of the business. To understand the extent of job security and the prospects of their future careers. Tax authorities, e.g., Lagos State Board of Internal Revenue, LSPR, or Federal Board of Inland Revenue, FBIR. To determine the amount of tax to be paid by the business. The government. To compute statistics about businesses operating in the country. To enhance the formulation of government policies, for example, on industrialization. The public. For employment and economic considerations. To know whether to invest in the enterprise. Importance of bookkeeping and accounting or reasons why accounting records are kept. To determine the profit or loss made by the business during a particular trading period. The existence of financial records helps in decision-making by managers of the business. Financial records help in the prevention of fraud. Thanks for watching. See you in the next video.